Welcome to our series of options and option strategies. We will be discussing in detail everything about options and option strategies. This will include basic strategies, intermediate strategies, advanced strategies, and exotic or niche strategies. By the end of our series, you should be a knowledgeable options trader familiar with most strategies. It is important that you subscribe, like, comment, and hit that notification button to get the most out of this series. So let's get started. Our first series consists of basic strategies. We will be talking about the long call, also called a bullish option. A long call is a strategy where you buy a call option because you expect a stock's price to go up. A call option is basically a contract that gives you the right but not the obligation to buy a stock at a set price called the strike price within a certain time period before the option's expiration date. You pay an upfront fee for this contract known as the premium, which is the price of the option. This premium is the most you can ever lose on the trade. Your downside risk is limited to that cost. Think of buying a call option like putting down a deposit or buying a coupon for something you might want in the future. For example, imagine you pay $50 for a coupon that lets you buy a new smartphone for $1,000 anytime in the next 3 months. Here, $1,000 is like the strike price, the locked-in purchase price, and $50 is the premium, the cost of the coupon. If in 3 months the smartphone's price jumps to $1,200, you can use your coupon to buy it at $1,000 and then enjoy a $200 savings. After accounting for the $50 fee, your net gain is $150. If the phone's price stays at $1,000 or drops below it, your coupon wouldn't be useful. Why use it to pay $1,000 when the market price is the same or lower? So, you'd let it expire. In that case, you lose only the $50 you paid for the coupon. This is exactly how a long call works for stocks. You pay a small cost up front to lock in a buying price, hoping the stock's market price will rise well above that price. In stock terms, when you buy a call option, you're bullish. You think the stock will go up. The call option gives you the right to purchase the stock at the strike price no matter how high the market price goes. If the stock's market price rises above the strike price, the call option becomes valuable because it lets you buy the stock cheaper than the market. If the stock's price stays the same or goes down, the option becomes worthless, you wouldn't exercise it, and you're out only the premium you paid. One option contract typically covers 100 shares of the stock, which means a long call lets you control 100 shares with a much smaller investment than buying 100 shares outright. This leverage is a big attraction of call options. You can profit from the stock's rise without paying the full price of the shares. However, remember that the option expires after a set date. If you don't use it by then, it's gone along with the premium you paid. Bottom line, a long call is a straightforward bullish strategy. You pay a premium for the right to buy stock at a fixed price. Your risk is limited to that premium, and your potential reward is high if the stock price soars. In order for you to actually make a profit, the stock's price has to rise above the strike price, plus the premium you paid. This combined amount is your break-even point at expiration. If it does, you can either exercise the option to buy the stock at the bargain price or simply sell the option itself for a profit. If it doesn't, your option will expire worthless, and you lose only the premium. Next, let's look at a real-world example with Apple stock to make this concrete. To see how a long call works in practice, let's use a real stock. Apple Inc. AAPL is trading around $198 per share in mid-April 2025. Suppose you are optimistic that Apple's stock price will rise in the next month. You decide to buy a call option on Apple with a strike price of $200 that expires 1 month from now. The premium or cost for this call option is, say, $8 per share. Since one contract covers 100 shares, you pay $800 in total premium for one call option contract. Alright, let's talk about the initial cost and maximum loss. You pay $8 per share, totaling $800 for one contract. This $800 is your maximum possible loss on this trade. No matter what happens, you can't lose more than $800, even if Apple's stock completely crashes, because you're not obligated to buy the shares. You would just let the option expire if it's not profitable to exercise. Now, let's move on to the break-even price. The break-even point for your call option is $208 per share. This comes from adding the $8 premium to the $200 strike price. That is, $200 plus $8 equals $208. This means at expiration you only start making net profit if Apple's stock price is above $208. If the stock is exactly $208 at expiration, you break even because the gain from the option equals the $8 premium you paid, so your net profit is zero. Now let's consider scenario 1. The stock rises above the strike. Say by expiration Apple's stock price jumps to $220. Now your call option is deep in the money, meaning the stock price is well above your $200 strike. You have the right to buy Apple shares at $200 and could immediately sell them at the market price of $220. That's a $20 gain per share. However, remember you paid $8 per share for the option, so your net profit is $12 per share, which is $220 minus $200 minus $8 in costs. For 100 shares or one contract, that's a $1,200 profit. You could achieve this profit either by exercising the option, buying at $200 and then selling the shares at $220, or more simply by selling the option contract itself, which would be worth around $20 per share at expiration, its intrinsic value. This scenario shows the upside, because the stock rose well above your break. Even of $208, you made a healthy profit. Importantly, note how large the return is relative to your initial $800 investment. This illustrates the high reward potential of a long call if the stock moves in your favor. Scenario 2, stock stays flat or drops. Now imagine that by expiration Apple's stock price is below the strike price, say it stays around $190. In this case, your call option would expire worthless because nobody would want to use a right to buy at $200 when the stock is only $190 on the market. You certainly wouldn't exercise it, since you could buy the stock cheaper directly from the market than using the option. Because the option expires worthless, you lose 100% of the premium you paid. Your total loss is $800, which is the money you spent up front. This is the worst case scenario, but notice that it's a limited loss. You didn't own the shares, so you didn't lose any more than the option's cost. Whether Apple goes to $190, $150, or even zero, your maximum loss is still just the $800 premium. Scenario 3, stock rises but not enough. Finally, consider Apple's price reaches somewhere between $200 and $208 by expiration. For example, assume it goes to $205. Your option at $200 strike is now slightly in the money because $205 is above $200, so it has some value at expiration, specifically $5 per share of intrinsic value. If you exercise the option, you could buy shares at $200 and immediately sell at $205, gaining $5 per share. However, since you paid $8 per share for the option, you're still short $3 per share overall. In fact, at $205, you would be better off selling the option's remaining value, around $5 per share, rather than exercising, but either way your net loss would be $3 per share, a $300 loss on the contract. Any final stock price between $200 and $208 means you recover some of your premium, because the option will have some intrinsic value if above $200. But you won't recover all of it. Only once the stock exceeds $208 do you fully cover the premium and start making net profits. So if Apple had ended at $208 exactly, you'd break even, no profit, no loss. And if it ended at $210, you'd have a small profit per share. $210 minus $200 equals $10 intrinsic value, minus $8 premium equals $2 net gain per share, $200 total for the contract. In summary, buying this Apple call option for $800 gives you upside if the stock climbs, with a clear break, even at $208. If Apple's price rallies above $208 by expiration, your option investment pays off in profit. If Apple's price doesn't rise that high, you end up with a loss, limited to at most $800. This example highlights the key aspects of a long call limited risk, a known break-even point, and potentially large returns if the stock makes a strong move upward. A long call means you have the right, but not the obligation, to buy the underlying stock at the strike price before the option expires. You are not forced to buy the shares, it's your choice. If the stock doesn't go up, you simply won't use the option. A long call means you have the right, but not the obligation, to buy the underlying stock at the strike price before the option expires. You are not forced to buy the shares, it's your choice. If the stock doesn't go up, you simply won't use the option. You pay a premium to buy the call option. This is the cost of the contract. This premium is the maximum amount you can lose on a long call trade. If the stock ends up below the strike price at expiration, the option expires worthless, and you lose only this premium. You cannot lose more than this amount, making it a defined risk strategy. Alright, let's talk about the break-even point. The break-even price at expiration for a long call is, well, the strike price plus the premium you paid. For instance, in our example, a strike price of $200 plus an $8 premium gives us a break-even of $208. This is essentially the stock price you need to hit just to recover your initial cost. Now, if the stock's price is above this level at expiration, the strategy is profitable. But if it's below, you end up with a net loss on the trade. Unlimited upside potential. A long call has unlimited profit potential if the stock price skyrockets. There's no cap on how high the stock can go, and thus no cap on your possible gains. The higher the stock price goes above the strike, after covering the premium cost, the more profit you make. This is the big appeal. Your gains grow as the stock rises, theoretically without limit. Use when bullish on a stock. Investors buy call options when they are bullish on a stock. That is, when you expect the stock's price to rise significantly in the near future. It's a way to bet on the upside with limited downside. For example, if you think Apple's shares will surge, a long call lets you profit from that surge by paying a fraction of the stock's price up front, the premium, instead of buying many shares outright. Leverage and lower capital outlay. Buying a call option lets you control 100 shares with a relatively small amount of money. In our example, $800 lets you participate in the gains of 100 Apple shares. To buy 100 Apple shares at $198 would require $19,800. Thus, long calls offer leverage. A small investment can yield a large exposure. This also means returns can be magnified, both the potential profits and the percentage losses. If the option expires worthless, you lose 100% of the premium. Always be mindful that while the dollar loss is limited, it's possible to lose the entire premium if the stock doesn't move as expected. By understanding these key points, you can see that a long call is a simple yet powerful option strategy for bullish investors. It's like paying a small fee for a chance to lock in a stock's price and benefit from a big move up, while knowing exactly how much you could lose if things don't go your way. The trade-off is the premium you pay versus the potential reward if the stock rises. In short, with a long call, your risk is capped at the premium paid, your break-even is strike plus premium, and your upside is as high as the market can take the stock. It's a beginner-friendly way to start using options to amplify your gains when you have a strong positive view on a stock. The next video in the series is the long put. This is the strategy you use when you think the stock will go down. It's called the bearish strategy. To be notified, click that notification button and don't forget to subscribe.